Hey there, everyone. Today on the final bar, big-time distribution day for stocks. The S&P closing below 4,300 for the first time since early June. Bearish breadth conditions continue with 85% of the S&P 500 members now below their 50-day moving average. That's down from around 90% being above in sort of mid-July going into the July peak. Finally, Tom Bowley of Earnings Beats is going to be joining us from South Carolina. We'll talk football. We'll also talk which charts can help us potentially identify a bottom in this market. Ladies and gentlemen, this is the final bar. Hey there, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market activity using the best practices of technical analysis. Technical Toolkit is all about focusing on price action as a reflection of what all the buyers and sellers, all the market participants are thinking and feeling, and how that is manifested into stock price behavior. By analyzing the prices of stocks and ETFs, of futures, commodities, and currencies, we can start to define trends. We can focus on peaks and valleys or highs and lows and recognize shifts in those trends, what we call a change of character. I always argue we've definitely seen a change of character in the markets, right? June, July, we have a market in a position of strength. We have pretty much all the FANG stocks making higher highs and higher lows, sort of a long and strong, everything feels bullish type of environment. All of a sudden, things have changed, right? In the last month or two, we've seen positions of strength go to positions of weakness. Stocks like Tesla and Microsoft and Apple gapping lower, breaking through key support levels. There have been holdouts, charts like Alphabet, that have been holding up quite well. Now they're actually starting to break down, and we've got some pretty serious distribution patterns, arguably, on the major equity indexes. We have a great guest today, Tom Bowley, a longtime Stock Charts contributor, former host of one of the most popular shows on Stock Charts TV, and continues to publish a lot of great analysis and research. He's going to talk about this particular corrective period and really important comments about how it relates to previous pullbacks that we've experienced over the last year or two. A lot of great content to share with you. Let's get right to our market recap and talk about what happened today, because again, a bit of a distribution day all around. Before we get there, quick poll question we asked you. Where is the S&P 500 1 month from today? At least 10% higher, at least 10% lower, somewhere in the middle. Now, what's interesting is if you look at the results on your screen, quick math, let's see, 62% basically said we'll end within 1 month, we'll be within 10% of current levels. Only 17% super bullish, over 10% higher. Only 20% at least 10% lower. But look, if you look at the the bulls versus bears, not too different actually. Those net out to a pretty similar result for bulls versus bears. Let's look at a chart of the S&P 500. And I took it from kind of yesterday, early today, because we asked this question over the last 24 hours or so. So, not exactly sure what was going on when people are answering that question. But if we start the clock right at 4,300, a 10% rally in the next month, again, 10% in a month would be a lot to ask of any market, but particularly the S&P given current conditions. Having said that, if we would go over 10% higher, that would actually be a retest of all-time highs. We'd be above 4,700. We'd be talking about whether or not we can power through. I see that as a pretty unlikely scenario, and again, the votes I think sort of reflect that. So the 17% looking for a 1 month move above that level, that is super. That would be an incredible black swan event to see. 10% lower would get us below 3,900. That would be actually retesting low from March of 2023. And again, the chances of us getting that far down in 4 trading weeks, pretty unusual. I mean, it's possible, certainly theoretically, but I would say highly unlikely that we would be able to just straight line down. That would be a crash scenario of some sort. And again, possible, but unlikely. That leaves us with these other two scenarios. I'd probably say the between 0 and 10% lower, only because I would argue that what we've seen over the last week or so with the gap lower and then additional movement to the downside, just this simple analysis of looking at a price gap, right? What happens after the price gap, I find a lot of times can be really instructive because it tells you a lot about the sentiment once investors have started to digest the fact that the market gapped lower. Look at the S&P chart, the gap lower, retesting that low from August. But then we just continue lower, right? Every day we've seen a lower low than the previous day. So you're not really seeing buyers come in in volume and accumulate on weakness, you're seeing additional selling pressure pushing prices to the downside. And I would argue that a month from now, I think we're either, we may be headed back upwards, but I don't think this downward move is done yet. And so that's where I would probably vote on that one. But an interesting question. I hope it makes you think about the possibilities and how your portfolio, how a particular stock or ETF would perform in those different scenarios. That is what I call a probabilistic analysis. I hope you think along those lines. That's what institutional investors would do. And I find individual investors usually don't do that enough. You kind of get caught up in a particular narrative. Rates are going up, stocks are going down, Bitcoin's going up, whatever it is, instead of thinking about different possibilities. Please use this show as an opportunity to think about some of those different possibilities and what the probabilities may be for each of those future paths. Continuing on with our market recap, as I mentioned, very much a distribution day is how I would describe today. And I just describe that as generally when most things are down, when you have major averages down over 1%, sort of feels like an influx of selling pressure or an evaporation of buyers is causing prices to go down pretty quickly. The S&P finished today down about 1.5%. I mentioned in the intro that's below 4,300. We got to just above 4,270, and we slightly went below that earlier this afternoon before kind of bouncing briefly into the close. So big distribution day, again, closing below 4,300 for the first time since early June. So it's been a couple months. The NASDAQ composite, even more so, down about 1.6%. Mid caps and small caps, all about the same to the downside. So no real clear leadership between those three, I would argue. And the VIX now a 19 handle. This is a full 2 points higher. It's one of the biggest moves we've seen, certainly to the upside in the VIX this year, and quite a rise. Now, the challenge I would say with this, or the concern, is this now takes it above the level of the VIX that we saw at the August pullback. We'll look at that chart here in a few moments, time permitting. Now, part of this story, as we've seen distribution, has been rates going higher. The bond markets are selling off as well. So the TLT was down about 1/3%. You can see that the yield curve, which is the top four options here, all in the green. So not a big, huge move higher, but certainly not moving lower. The 10-year yield finishing the day around 4.56, we'll call it, and the 30-year yield almost to 4.7%. Dollar index up slightly, about 1/3% for the UUP ETF. Looking at commodities, kind of mixed results, but overall more red than green, particularly precious metals moving lower. Now, gold has not materialized with any sort of strength here recently. So if you're looking for that sort of inflation hedge that I've heard about, continues to not play particularly well. Gold selling off here through the course of recent weeks and months. The GLD is down 0.8%. Silver underperforming as well, down about 1.1%. We highlighted that on yesterday's show. More of the same today. Oil prices up slightly. So you had the USO, which is a crude oil ETF, up about 0.6%. Natural gas prices, on the other hand, moving to the downside. Cryptocurrency is kind of an sort of day, an unchanged type of day. Not big movements either way. Bitcoin down slightly, Ethereum up slightly. But we didn't really make any gains significantly relative to where we were at the end of the trading day yesterday. Bitcoin down just 0.1%. We'll call it 26,260 and change. Finally, looking at sectors, it was energy at the top of the list, and what a familiar view that has been, right? I feel like the average day has kind of looked like that with energy at the top, usually having absolute gains. Today, not. The top performing sector down 0.6%, followed by consumer staples, which has not usually been at the top of the list. That was down 0.7%. Healthcare, number 3, still down almost 0.9%. On the downside, utilities really got crushed today, down 3%. Consumer discretionary and technology down 1.8%. So again, I would argue, and I was at a conference over the weekend down in Las Vegas with the guys at FX Evolution, had a good conversation with a number of the attendees there. One of the things we were talking about is how, as an institutional investor, you spend an amazing amount of time, what I did not appreciate before I got to a large money management firm, you spend a ton of time thinking about benchmarks, thinking about indexes, thinking about how they're weighted, because your job is to outperform them. So the way you learn to outperform them is by understanding them deeply and recognizing where the opportunities might be, recognizing where you may not have much of an edge. One of the things you need to think about a lot, I think, as an equity investor, particularly if you're comparing your performance at all to a passive benchmark like the S&P 500, is recognizing the sector weightings. So we kind of show these sectors, and sort of imply an equal footing, which sector's up, which sector's down. But you have to remember that consumer discretionary or technology are pretty big weights. These are two of the biggest sectors in the S&P. So if those two sectors are both down 1.8%, the chance of the S&P being anything but down a pretty decent amount is very, very low, if not minimal, right? So the sectors and where they're moving and the size of those sectors, the weights of those sectors in the benchmark or in the index has a very important say in terms of the performance of the indexes themselves. So some of the biggest sectors struggling today, that means your benchmarks are going to be down. Let's look at the chart of the S&P 500. And again, it's not great in terms of if you're bullish here and you're looking for a buyable moment. I would argue you're not really seeing that. And we talked about this through the course of the last week, right? If you look at the chart of the S&P, you have the this downtrend. Now here's today's session. Here's Monday. Then you have Friday, Thursday. Here's the Fed day when we closed down at the lows, closed around 4,400. The next day we opened lower and broke down through this neckline. If you think of this as a head and shoulders topping pattern, which I think is a fair way to measure it. Then we rallied going into the close yesterday, but still made a lower low. Today, just sort of right back to the distribution phase. Today's close takes the S&P below a trend line using the October and the March lows. Now, depending on how you measure this, like if you look at the closing prices, I don't know if it's necessarily broken yet. It might have done so today, but I'm usually looking at it using the intraday lows for some of those major points. And in either case, you're certainly seeing distribution. I think even more negatively would be the equal-weighted indexes. The equal-weighted S&P, the equal-weighted QQQ, both have already broken down through that trend line. So, certainly some distribution. I'm not seeing anything, today saying that was the obvious low. I'm seeing a pattern of distribution that is not done yet. Now, we can also think of this in terms of breadth indicators. So one of the common ones we've referred to is the percent of stocks above their 50 and 200-day moving averages. I mentioned it was down to around 15% of S&P stocks above their 50-day. So the other side of that is 85% are now below. Now, back here in late July, at the July peak, 90% of the S&P stocks were above their 50-day. Now, 85% are below. So most stocks in the S&P have broken down through that key level of short-term support, and I think that's the key, short-term support. Longer-term version is how many stocks are above their 200-day, and that's still around 40%. It's less than 50%, which is not on the surface particularly bullish in my opinion. However, look at where this has been back in late May, which was a sort of a time correction, back in mid-March, which was more of a price correction coming out of the February peak. In both of those cases, this indicator bottomed out right about at current levels. So if you think of this as a three-wave down move, maybe we're nearing that point where the breadth conditions are at similar levels that they were at some of those other major stopping points. Again, I think that is more of an anticipatory sort of signal. For me, I'd much rather wait for confirmation. And again, for now, I see this as more of a sign of further distribution than it is in any sort of bullish reading. Now, interest rates, of course, continue to be a pretty significant data point to pay attention to. Also, volatility. So look at the VIX today, getting just above 19, or right around the 19 level. And again, this is up from around 13 just a couple weeks ago, right? So as we rally into the end of August, come down right after Labor Day, that secondary high there saw the VIX remaining right around 13 and change. Now we've spiked right back up, and the VIX has now exceeded its level that it was in the August pullback. So one of the key sort of back of the envelopes, are we bullish or bearish types of indicators I look at, is the VIX above or below 20? When the VIX is below 20, I think of that as a low volatility environment. That means investors are not getting too nervous. That means there's not a lot of anxiety, certainly as reflected or as measured by the VIX, which is looking at the options market for the S&P index options. The 20 level is getting closer and closer. It's certainly not getting farther away. And just today, you saw a spike from around 17 to around 19. So we're certainly getting up to that level. We break above 20, and I think you have to recognize this could be, or at least think about the possibility of this being the beginning of something more significant to the downside. This is where the VIX topped out in May a couple of these times. This was more of a time correction back here. But if you look, the VIX kind of topped out around 20 and then came down. And that was one of the signals that the uptrend was going to resume. That might be the level to pay attention to on the VIX. Now, one of the charts that I want to show you, and I forget where I put this chart, so how quickly can I find it? That's the real question. I think it's under intermarket analysis. If I was going to do it today, I would put it here and I would call it earning. Here we go. So, there are different ways you can think about the relative value of stocks versus bonds, or I guess the relative yield component, if that's a way to describe it. The 10-year yield has gone up, right, from around 0.5% a couple years ago here in mid-2020. This is obviously during the the COVID era, pushing much higher now, about above 4.5%. That's just the straight yield on the 10-year. Now, this is the dividend yield on the S&P 500. It's currently around 1.6%. And what that basically means is for $1 invested in the S&P, what are you getting back in terms of a dividend component? So it's one component. The other thing you can do is an earnings yield, which basically is the PE of the S&P 500 flipped over. I don't have that on this chart. I didn't have time to set it up. It's currently around 4 to 4.25%, depending on how you measure the earnings side of that, what price you're looking at particularly. So the problem with both of those, if you look at dividends, if you look at earnings, in either case, bonds are a better yield instrument, a better source of income than equities, right? And so previously, when you talk about markets going defensive, you could go to high income equities and have a pretty decent yield. But now, relatively speaking, you actually can do much better in a savings account than you probably could with most equity-related income components, given how much rates have gone higher. And that's one of the dynamics that occurs when you see rates rise to this point. And certainly if it would go further, less and less equities become a meaningful opportunity based on their relative yields. With that in mind, though, stocks continue to outperform bonds, and that's a ratio I would certainly be looking for to see if that continues. Just to finish off with a stock or two, Amazon, along with many, breaking down here. And again, the chart of Amazon is one of those mega cap names that was holding up quite well. And so when you're looking at charts like Amazon, when you're looking at charts like Alphabet, I think the reason why these are helpful is when the market starts to pull back, when you see support levels failing, when you see stocks breaking their 50-day, I'm always keen to find names where that is not the case, right? Names that are actually holding up well, because that shows you that despite the broader market rotating lower, these are safe haven instruments of some sort. There's enough in the individual stocks and the value proposition of these equities that investors are willing to hold them and even bid them up higher while the market's going down. That's all changed now. And in the last week, you saw Alphabet rotate lower. This is around the Fed meeting day last week. And then you saw further downside. We're now below the 50-day moving average, now currently testing the August low for Alphabet. Amazon, on its other hand, has now broken down through the 50-day. It gapped below the 50-day last week. Now continue to push lower. We're well below the August low, down another 4%. So I think one of the more concerning additional data points we've picked up here in the last week are some of these kind of bellwether names, these big mega cap stocks that had been continuing to make higher highs and higher lows, kind of failing to do so. NVIDIA may be one of the last ones, still holding above its August low. And again, the more and more that stocks test those previous swing lows and then fail, that is, as Ralph Akinpour told us when he was in our offices a couple weeks ago, in an uptrend, you look at the lows, right? Do we keep making higher lows? We're going to pull back, that's fine, but do we make a higher low? And as long as that continues, things are not getting that bad. Charts like NVIDIA, charts like Alphabet, with those lows in play, I think it's important to watch to see if those levels will continue to hold going forward. That's our market recap for today. Again, quite a distribution day, a lot of charts to review. Those are some of the ones that stood out for me, trying to digest what we saw in the markets. Before we bring on today's guest, Tom Bowley, a couple quick announcements. First off, we would love to hear from you in terms of questions that you're coming up with. What are you running into as you're analyzing the markets using the Stock Charts platform, using the best practices of technical analysis? We are here to point you in the right direction. Our email is thefinalbar@stockcharts.com. We are on X @FinalBarSCTV, so just tag us in a comment there. On our YouTube channel, just drop a comment below the video that you're watching. We'll gather all of those and hope to answer one of your questions in our next mailbag show. That'll be on Friday of this week. Also, a reminder, we do a live Q&A every Wednesday at 1 p.m. Eastern, 10 a.m. Pacific here on our YouTube channel. We go to our podcast studio just around the corner from our TV studio here. We set up and open the chat room. I'll have a chart or two queued up just to get the conversation going, and then we will start with all of the questions that you're sending in. We will have the super chats turned on, so if you want to make sure your question gets answered, you can pop it right to the top of the queue very, very easily. Also, as a reminder, Charting Forward was our fantastic market outlook special that we did a couple weeks ago. Today's guest, Tom Bowley, was one of the 3 participants along with me. We had a fantastic conversation about the markets. A lot of the things we talked about, as I hope Tom will address, have kind of come to fruition, particularly the seasonal weakness that you'd expect in September into October. With that in mind, let's bring on today's guest, Tom Bowley. Tom's the Chief Market Strategist at Earnings Beats, coming to us live from South Carolina. Tom, I did mention, I just teased football, but we don't have to go there. Football aside, how are you these days? You all right?
Well, now that you mentioned football, I'm not doing as well as I was previously, but no, I'm doing good. Market obviously took a little turn, as you were most eloquently pointing out earlier. But yeah, that was a pretty big level at 4,300 on the S&P 500 that fell. And so, taking a look at the chart, you can see even back when we look, into the cyclical bear market that we saw in 2022, 4,300 represented a really big support area on the way down. And now on the way back up, we went through, I think it was in June, early June, we took out that 4,300 level and had not retested it until yesterday. We got down to 302 intraday. We bounced, we held it, everything looked pretty good until today. Today we went through, and this time the S&P 500 closed down on its lows or near its lows, easily below that support level. And while I do have a lot of signals, below the surface signals, that still tell me that this is not going to be a long-term move to the downside, I always respect price. And the price action today was very bearish. It caused me to get much, much more defensive into the close. And we were talking about it before the show started, but I'm looking for some sort of a capitulatory move to the downside. And I think, if we go down, we were talking about this, but a lot of the previous lows, I mean, if you go back and you look at the January 2022 low, we see a big hammer. The February 2022 low, we saw a big, it looks like an engulfing candle, both of those on heavy volume. But you can go on to May of 2022. We put in a hammer toward the end of May that marked a very significant low. Then there was a double bottom right there in mid-June. Not so much a big reversal, but we did see volume spike up at that point. And then October, that was the big low. That, if you recall, was the September CPI came out that morning, was really bad. The market, after falling for the previous 5 or 6 sessions, took a big gap down, and you see that massive reversal. That's what we look for when we're talking about capitulation, where you've been going down. In this case, we got bad news. The market fell at the beginning and then rallied back. I think we're at a point at this point in the market where we need that capitulatory move. Now that we've broken down below not only the lows that we saw in June and again in August, which you've pointed out many times on your show, we also took out that 4305 level, which I thought was a really big level. And that dates back to that August high. And the reason I always felt that was so big was that in that cyclical bear market, you remain in it until you start to break that series of lower lows and lower highs. And that August 2022 high was our last lower high that we eventually took out in June. And so that was confirmation that the earlier bottom that I had talked about in a couple of different YouTube sessions, that to me was confirmation that those bottoms are in. Well, here we are now going back down below that 4,300 level, which I don't like. But I think if we move on to the next chart, Dave, you'll see that this is not setting up the way we set up back at the beginning of 2022. So what I've done is I've put in really dark red shading to highlight the last hurrah back in December of 2021, also again in January of 2023, and then again in just more recently in July when we put in that last high. And then the light colored red shaded area is what happened afterwards on the way down. And each of these three that I point out all set up in that ABC corrective kind of pattern. But when you look at the panels beneath the S&P 500, that highlights the more growth oriented or aggressive areas of the market versus the value or defensive areas of the market. And what we saw at the end of 2021 and early 2022 was money rotating in very heavy fashion away from aggressive areas and into defensive areas. And as we kept going lower on the S&P 500, that continued. It accelerated to the downside. What we see different in 2023, starting with that January move and then the pullback. Of course, remember we had the banking issues. That was kind of what sent us down in March to that final low. That was also an ABC pattern. But during that pattern, you can see that the relationship between aggressive and defensive really didn't change that much. And as we started that move back to the upside, or actually that final low, you can see that in the light red shaded area, we're actually starting to turn higher in some of the areas. And as the market started to rebound, money rotated back into the aggressive areas again. And so I think as we're looking at this right now, number one, we need capitulation. We need to break the series of lower lows and lower highs that we see on the chart. Until that happens, you can't be bullish here. It's simply, market breaking down, price action lost, and we're showing a series of lower lows and lower highs. So I think the way the next rebound happens and what happens to the market in terms of rotation, I think that's going to give us a pretty big clue as to whether or not we're going back down again, or whether or not we see a capitulatory bottom similar to what we saw back in October of last year.
There's so many great points that you touched on there, Tom. Particularly, highlighting in some of those major pullbacks. Most of the time, if not all of these previous ones, we've had this short-term signal, right? The candle pattern, some reversal signal that would indicate a low. Can you talk a little bit more about short-term versus long-term? Because I think what a lot of people see, some of the breakdowns we've seen this week, in the last week, you start thinking, uh-oh, the market's going down, and all of a sudden I need to get super defensive. How are you thinking about this in terms of how this pullback fits into more of the bigger picture view of what to expect between now and year end into next year? Is this end up being more of a bigger buying opportunity in a long-term uptrend, or how are you thinking of it that way?
Well, I think I think it's going to depend. If we go back to August of 2022, remember we had that Jackson Hole speech by Fed Chief Powell where he said more pain ahead. And that kind of changed the whole character of the market after that announcement. And if you go back on that chart, yeah, right there, the big red candle, that was August 25th. That was literally as Fed Chief Powell was speaking that day. And I think it changed Wall Street's confidence. I don't know what you want to call it, but in the Fed, because they kind of changed their tune at that point and took on market prognostication, which I don't think is part of their mandate. But that, I think, spooked the market a little bit, and I think led to what we saw into that October low. If you look at what happened last week on Wednesday, the Fed made another subtle change, maybe not so subtle, saying that interest rates were going to stay higher longer than what they previously expected, and suggested that we would get 2 rate cuts in 2024 instead of 4 that were previously discussed. So I'm kind of watching this last week as maybe the market saying, something similar to what they said back in August of 2022. Maybe this is something different because of the Fed. I'm open right now, honestly, to which way we go here. I just think in order to really become bullish longer term, and many of my signals do still point to long-term bullishness, in order to turn more bullish, be more confident, I think we need to see capitulation, and I think we need to see an uptrend resume and take out some key levels. Until that happens, I think you have no choice but to remain a little bit defensive here.
I love that way of sort of describing, focusing on the evidence. Let's let the evidence evolve, right? And I would totally agree, Tom. You've seen it certainly felt like a different market from last Wednesday up till about 2:30 p.m. Eastern. From that moment on, it's had a very different feel, and we've seen a lot of stocks returning lower. When we had you on Charting Forward a couple weeks ago, which was a lot of fun, you and I, as Ms. Schneider, Julius DeCamp, are all having a discussion. Seasonality came up quite a bit, and when you look at what's happened in September so far, how much do you see seasonality as part of the overall picture that we're observing here?
Yeah, seasonality was part of the reason why I started getting more defensive back in mid-July. I know, mainstream media, you hear go away in May. That's kind of the mantra that you commonly hear. For me, it's more about, fly in mid-July. I don't know, it's a little bit different. Because I've got the numbers on the S&P 500, the daily numbers dating back to 1950. And to be honest, July 17th at the close to September 26th at the close, which is today, that tends to be the weakest part of the calendar year. So I'm not surprised. I think, this has kind of followed the path of seasonality. Seasonality tells us to be a little bit more cautious. But I think there's a little bit more to it than just seasonality. I mean, seasonality certainly is not my go-to on a regular basis. I'm aware of it, and I think it added to the more cautious case back in the middle part of July. And from here, by the way, the Q4 historical performance is significantly higher than any other quarter of the year, and that extends really into the middle part of January. So seasonality would tell us, hey, now it's time to get back in. I don't know if it's going to be quite that easy that you get out in mid-July and then jump back in on September 26th. Again, I want to see confirmation of that on the charts and in the price action. But it is interesting that we do flip. And in charting forward, I remember going back and reading the daily annualized returns from September 20th toward the end of September, and they were not pretty. And this kind of has followed right along suit with that.
I was going to say, you listed them out day by day. It was fantastic, and so far, I mean, it's been a great way of thinking about this market. We only have about a minute left, Tom, but I'd love to ask you, given everything that you've described, given the market and distribution, a lack of capitulation, which I would not disagree with, how do you play this period here? Is it a sit on your hands, wait for an opportunity, or are there areas of the market that you see as opportunities given a bit of deterioration, maybe a little bit going forward?
I know at the charting forward, one area that I mentioned a couple of times I really liked was the healthcare providers. And that group has really done well since then. And I think on a relative basis, that could be an area maybe to look at. Healthcare has been doing much better on a relative basis. But I think, honestly, it just comes down to which side you're on. Are you bullish or are you bearish? And there's not anything wrong with being on either side. I mean, everybody's got to choose, right? There's a decision that everybody has to make based on their own risk tolerance and so forth. But I think if you're bearish here, you got a breakdown. I think you play it on the short side. My personal preference, when I believe that we're still in a bull market, which I do, is to sit on my hands. I think once you make this breakdown, I think you need to see something price-wise to make you feel better about being long. Right now, I don't think it's any time to try to be a hero.
Tom, this has been awesome. What a fantastic way to describe what's going on. I really appreciate you pointing out some of those capitulation measures. I think I knew that, but until you really talked through it, it became very, very clear. So I appreciate it. Stay safe, be well there. Good luck to your teams. I wish you the best, unless you're playing the Browns, and we'll see you next time, all right?
That sounds good. Thanks, Dave. Appreciate it.
That's Tom Bowley. Tom's the chief market strategist at Earnings Beats. I actually promised him I wouldn't talk about football, and that I couldn't help it because my Browns are 2-1, and I have to celebrate that. But listen, I think Tom's points were absolutely well said. And what I appreciate about Tom, I mean, focusing on the evidence and focusing on what you're seeing and that change of character. There's no doubt the market has had a different feel. I 100% agree. But in those previous drawdowns, looking back, you saw clear signs of capitulation, clear signs that the distribution phase was maybe over because you saw buyers coming in. I would say on a day like today where you're breaking down, closing at the lows, not there yet. Be wary and be ready for those signs of capitulation. Great take there and some brilliant market wisdom by Tom Bowley of Earnings Beats. Let's continue on and close our show with the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. And I'm looking at the VIX here. I have a chart of the S&P 500. Tom's charts show that ABC corrective pattern. I think that's one of the ways certainly to measure the performance that we've seen here. I think it's a debate. For me personally, whether this is a head and shoulders top that's broken or whether this is an ABC correction similar to some of the previous pullbacks that we've seen. What's interesting to me is you're starting to see the VIX have a little different feel than we saw in August, right? The VIX up until today was kind of topping out around that same level, right around 18. Today was a nice move higher for the VIX. And what I mean is a significant increase in what we call the fear gauge. We're close to that 20 level, and in previous corrections, we hold below 20, that is, for the VIX, and things just are not getting that uncomfortable as measured by this particular gauge of volatility. VIX gets above 20, all of a sudden this is more where a lot of investors would consider a high volatility environment. Good things don't tend to happen in high volatility environments until you get some reversal. And so I would argue this is starting to get more and more distributive. We're getting to those points where I think you have to start thinking about potential further downside and how to manage that potential risk. Chart number 2 is Tesla. I wanted to highlight one of the FANG stocks, arguably still indifferent. I think this is, some of the ones have broken down, like a Netflix makes me a little more concerned. Some like Alphabet just breaking down. Tesla is really more consolidating. I'm wondering if it's as simple as just seeing which way this breaks, right? Tesla at some point is going to go higher than 300 or lower than 210, right? It's going to get above the July peak or below the August low. And I'm wondering if a simple indicator like that might be one of those gauges to show you that something's now different. And if things are really getting bad, a chart like Tesla's probably not going to hold up very well. It's probably going to break down as well. Look at how the RSI has been rotating between 40 and 60. Everything's sort of in this neutral sideways move, pulled back in the last week, but still holding above recent support levels. I'd be watching those FANG stocks very closely because breakdowns there tend to have really negative implications for the broader markets. Finally, one of the observations I didn't get to in the market recap, if you look at the dashboard today, if you're a Stock Charts member, which of course you all should be, if you look at your market dashboard, you'll find that the names that were up the most today were really coming off of fairly low levels. Mondelez, MDLZ, is a food products name. This is a group that has been struggling on a relative basis in a big way. These stocks have been down while the major averages were up in the second into the third quarter. MDLZ was one of the biggest gainers in the S&P today, but if you look, it's bouncing off of support. Now, potentially encouraging, right? 69 has been a level of support. That was the low right around Labor Day. That's the first Fibonacci support level, but these are beaten down stocks coming off of swing lows that are bouncing higher. Are we testing support at the 200-day? Are we holding support at the Fibonacci level? For now, that seems like a decent bet to maybe consider. But a break below 69, again, all of a sudden makes this chart look a lot worse than it did today. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the Final Bar. A special thank you to Tom Bowley of Earnings Beats, being part of our Charting Forward special earlier this month, but also coming on our show today live from South Carolina. For Mark of StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.